The property boom's over. Your house prices are going to fall by $200,000. That's what the media is saying at the moment. They're going on a merry-go-round between property boom, property bust, property boom, and bust again. So what is actually going on? And are property prices going to fall by a suspected $200,000 as the Reserve Bank increases interest rates sometime this year or next year? My name's Luke. I talk all things real estate, renovating, and financial freedom. Like this video and let's dive into this recent article. The property boom is over. How house prices in Australia's biggest cities could plunge by up to $200,000 in a matter of months as experts reveal the best time to buy. Now, the media makes money off clicks and they make money off sending people into boom and bust cycles, and so they're really chasing that next story. And it seems to have gone from all of this booming property market, and now the media is starting to turn to move to that bust phase. House prices in Australia's biggest city could fall by a staggering $200,000 by the end of next year, the Commonwealth Bank fears. Sydney's median value for a home with a backyard surged by 26% to $1.41 million in the year to February. That was based on CoreLogic data. The Commonwealth Bank, Australia's biggest home lender, is now predicting a house price drop starting this year in both Sydney and Melbourne, where auction clearance rates have peaked. Now, auction clearance rates peaking kind of makes sense in these major capital cities in Sydney and Melbourne. The prices are starting to get to an astronomical level that buyers are really starting to tap out, and they're also seeing value elsewhere. You know, in the Brisbanes, in the Hobarts, in the Perths and Adelaides, there's value buying in other major capital cities. So why not rent if I live in Sydney and invest my money in a more affordable market where I can get potentially better capital growth and definitely better cash flow in terms of a yield on those properties. As an early interest rate rise in 2022 was tipped to hit Australia's biggest housing markets first as prices continued to rise in the smaller major capital cities. As recently as November, Commonwealth Bank was forecasting 6% growth in Sydney. Now, Commonwealth Bank of Australia has actually revised their previous forecast, and they just released them at the start of March 2022. And what they're saying is that the adjusted home price forecasts are Sydney to fall by 3% in 2022, and then 9% in 2023, and Melbourne to have exactly the same declines. Brisbane to be up 7%, then down 7%, Adelaide up 6% and down 8%, and Perth up 2% and down 6%, and then the other major capital cities to have an upwards trend and then a downwards trend by some percentage points. So there's expected to be a real pullback based on the timing and the amount the RBA increases interest rates. It's all really hinged on interest rates at the moment. That's the big deciding factor as to where property prices go as far as the media is concerned. Now, in my opinion, I think yes, there might be a pullback in the property prices, but I think there's still great opportunities in the Brisbane market. When they're talking about prices falling in a city, it doesn't mean that each suburb is going to fall by 3 or by 9%. Or in Brisbane's case, that everything's actually going to go up by 7% this year and down by 7% next year. There are cities, then there are suburbs, then there are streets. So you've got to really narrow down to the street level as to where the growth will be. In my opinion, there are 3 kind of categories. You've got your market that is overvalued at the moment. So there's pockets or streets within suburbs that are potentially overpriced. The yields don't make sense. The purchase prices don't make sense. And that's where I see the property prices will have the largest pullback. The next section is where there is value opportunities. So we're looking for opportunities that have maybe had some growth, but there's still some capital growth potential in the short and long term. They've got reasonable rates in terms of the interest rates to the rental returns on those properties. And there's some great value buying in these pockets. The third section is their no-go zone. So these are properties that I wouldn't buy. They might be on main roads. They might be in flood areas. They're properties that might be in lower socioeconomic areas and might have higher crime rates and might not have the growth potential or the cash flow that you're looking for. So really, you're looking for those properties that are in the middle section that have value and have growth potential as well as cash flow, depending on your needs. Everyone is going to be different. Not one property buyer is the same as another. We all have different incomes. We all have different investments. So you really need to find the right property that meets your situation. Let's read on. So Rate City Research Director Sally Tyndall said house price growth in Australia's two biggest cities was already slowing. This could be the beginning of the end for the current property price peak in Australia's two biggest cities. And I have to agree, I think Sydney and Melbourne are potentially overpriced, and there should be potentially a pullback in property prices there, and there's going to be less demand in those markets as people see value elsewhere. Ms. Tyndall said someone buying a property in 2022 needed to brace for negative equity where they owed the bank more than the home was worth. People might not like the idea of losing equity in their home over the next few years, but it's worth looking at the bigger picture, she said. And any property price drops will be coming off the back of monumental gains that the country has seen over the last year and a half, which sent homeowners' equity skyrocketing. While falling property prices can be stressful for anyone buying at or near the peak, if they keep their head down and their mortgage repayments up, they should be able to ride out any dips. Lenders since November have been required to model a borrower's ability to cope with 3 percentage point increase in mortgage rates. Now let's talk about negative equity, and let's also talk about interest rate buffers in serviceability cases. So negative equity is a situation you don't want to be in. It's an awful situation. You can end up buying in a mining town, for example, if you bought in mining towns in the mid-2000s, and you might have paid $1 million and the property might be worth $500,000 now. Now that's an awful situation because you owe the bank money on that property if you were to sell today. So don't buy at the top, buy a property which has value add potential. So a renovator or a property that can be subdivided. Any properties which you can add value by manufacturing value will cushion you from any price decreases in the property market. Now, moving on to interest rates and cash flows. Your broker or your bank, when they assess you for lending, should be applying, as they said, from November 2021, a 3% increase in interest rates as they run your cash flows. Emily and I do this in our own situation. We have spreadsheets. The accountant in me loves the numbers, so I run the spreadsheets and run the numbers, looking at our current rental on the property, looking at the interest repayments, having a nice fat repair and maintenance budget as well. And we might not use all of those budgets, but it's good to run the worst case scenario. So you want to be running all of those numbers at least a 3% increase. So if you're paying 3%, run them at 6% at a minimum. It's probably better to run your repayments at, say, 7% with principal and interest repayments. This will really stress test your ability to hold your portfolio in tough times, and it will give you peace of mind or sleep at night factor. As you know, you stress tested the numbers all the way up to, say, a 7% interest rate on principal and interest repayments. Commonwealth Bank Head of Economics Gareth Aird said Sydney and Melbourne housing markets have begun to cool as buyer sentiment remains strong in Brisbane, Adelaide, Hobart and Canberra. House price booms cannot go on indefinitely, and this cycle looks to have run its course in Sydney and Melbourne. Brisbane's median price rose to 32.8% in the year to February, reaching a price of $828,000 as a median value. Now, to close this video out, I want to talk about Australian house price rises that have happened during the last year and looking at what might happen in the future. So Sydney's gone up 26% in the last 12 months. Melbourne up 15%, Brisbane up a whopping 32%, Adelaide up 28%, Hobart and Canberra up 25%, and Perth and Darwin have underperformed at only an 8% price increase based on median values. Now, what does this mean looking forward? This article is really jumping on that fear train now, worries about potential decreases in equity and trying to capture headlines there. So in my opinion, there will be an interest rate rise and people will react to that. There might be some demand coming out of the market, which may see some price decrease in property prices on the market, but also people are factoring this in. We're aware, we're seeing the media talk about interest rate increases. So if you're currently struggling at the moment in this low interest rate environment, in terms of your repayments and managing your investments, then you're probably going to struggle as the market sees an increase in interest rates. But for most people will have factored the buffers in and will be looking to potentially find the right opportunity for them, even if some markets see some price declines. That's exactly what I'll be doing for myself and for my clients in my business. We're looking for the right opportunity that meets your price point and meets your circumstances. So what do you think is going to happen this year and next year? Do you think this will all happen and property prices will start falling rapidly? Or are you holding for the long term and looking at at least a 15 to 20 year price horizon? Drop a like on this video, subscribe to the channel and click this video over here for more things real estate, renovating and financial freedom. I'll see you in the next one. Peace.